Strategic media and public relations is bringing together dynamic companies, investors, and consumers like no one before. And we're doing it in a unique way while addressing the big changes underway in our world. Our world is fraught with both peril and opportunity. The world is changing. Long-term conflicts are shaping up over commodities, currencies, and influence. Political lines are shifting. Yet mankind moves on to meet the needs of a growing world. Newer, cleaner energy, medical breakthroughs, ways to better our lives, better ways to move into the future. Join us now for today's topic.
Hello and welcome to the Reality Check series with Connie with a K Harrison and Chris Temple of the National Investor and Strategic Media and Public Relations. Episode 4 is all about the markets and the disconnect between value and what people are chasing. And all of you companies out there, you don't understand why your stock prices aren't going up, and it fluctuates differently than what is happening in your sector, particularly. Chris, this isn't new. This isn't the first time that this has happened. Can you give us a little bit of some kind of a historical perspective? Because, what comes to mind is, of course, the FANGs, which are now technically the MANGs, if you want to get real formal about it.
Yeah.
The MANGs, and the Magnificent Seven. So what is this all about? Can you explain a little bit of the history for us?
Well, Connie, the idea that a lot of people have that these days there is something different or new in the markets where value, commodities especially, don't get fair shakes in the marketplace, and yet everybody's chasing NVIDIA higher, or Apple, or they, as you said, were the FANGs for a while. Now it's the Magnificent Seven, whatever. This is not new. And we want to explain to folks today basically 3 different things. Number one, initially, that this is not the first time this has happened. There have been numerous interludes, if you want to go back a century, all the way to the Great Depression and what the stock market was like then. You've had instances along the way of this overconcentration in a handful of stock. And it's because, look, it's the herd mentality. That's how investors behave over time. And again, this is nothing new whatsoever. The second thing we want to explain, however, is that just as in all the past interludes where you had this happen, this is unsustainable. We all know it is, and it later proves to be unsustainable because the stuff that shouldn't be at nosebleed valuations starts to come back to reality, and what was forgotten and left on the wayside all of a sudden becomes relevant again. That recipe changes from one time to the other, but the pattern has repeated itself every single time. And I also believe that as a consequence, and we're starting to see some of this stuff on and off even in the last couple of years, believe it or not, that real value will reemerge as the big popular stuff starts to run into a wall.
Right. Which is good news, because real value is always good. You don't want that fake stuff going on out there. Can you give us, because all of that big stuff sounds great. Can you give us just a couple specific examples before we get into the dynamics on how those have changed and what we can expect?
Well, sure. I'll give you a few examples. If we look today, and here's, we're sharing a couple of charts as we go along, folks, to explain this. But if you look at the overvaluation, and we'll start with just for a second with today, the big moniker is the Magnificent Seven. That was the old FANG stocks: Facebook, Apple, Amazon, Netflix, and Google. And now you've added NVIDIA and you've added Tesla. Tesla's not so magnificent these days as we're recording this, because it's almost lost half of its market value as of now compared to its peak. But investors chase these small number of companies. And if you look, and here's one example, the overvaluation represented by the Magnificent Seven today is every bit as acute as the dot-com stocks were in 1999 and the beginning of 2000. And in 1998 and 1999, you had the same thing. If you were invested in a broad garden variety diversified mutual fund, you were doing so-so. If you were concentrated into the dot-com stocks, you were getting triple-digit returns, even on mutual funds that focused on those things. So, that was unsustainable. Everybody found out the hard way, after that. But you can go back to other epics, Connie. I mentioned the Great Depression. In 1929, you had a handful of stocks in the Dow Jones Industrials that looked every bit like the dot-com peak in 99 and 2000 and the current peak in the Magnificent Seven stocks. Okay. It gave way. In the period immediately after the stock market crash in 1929, from top to bottom, the Dow itself, because it was pacing all the rest of the market, lost 89% of its value. And yet during that decline, things were starting to turn around. Stuff that was value. People weren't just jumping out of buildings and selling everything and selling their cars and whatnot. People who were smart were figuring, okay, now we're going to come back to reality for a while, the reality of the economy and whatnot. What do we do? 1 out of 3 publicly traded companies were higher during the time that the Dow dropped 89%. And it didn't happen all with the flip of a switch or anything like that. This was an evolution as the overpriced stuff that everybody was chasing lost its air, then it went down. Okay, we go forward in time to speed things up. People, if they're old enough in our audience, remember the term the Nifty 50. Those were the early big tech stocks, the big conglomerates, the IBMs, the GEs, the AT&Ts, all that kind of stuff in the 60s, where you had the very first time mentioning the Dow that it hit 1,000. All right, that theme matured. All right. And I mentioned the dot-com peak in 2000, where again, you had this over concentration in a relatively small part of the market that was unsustainable. Yes, it was a great new technology, but this gets back to the herd mentality of investors. The average investor, even institutions, let alone individual investors, they always chase momentum. They stay too late. They lose their rear ends when the big correction happens, and they got to lick their wounds and start over again. People that are wise see these things as they play out, anticipate them, and get in. Here's an interesting thing, because I do, on this current time, want to tie the theme of our present market to what happened after the dot-com crash. All right. In 2001, the decline in the stock market started to worsen because of September 11th, and that threw the economy into a bigger tailspin. It accelerated the bear market. But even though the market didn't bottom for another year, if right after September 11th, you were buying real estate, commodities, almost anything that was interest sensitive, you were making money for the next year as the NASDAQ's decline continued and as the S&P 500's decline continued. And that was because back then the Fed was slashing interest rates. Today, we're seeing a peaking of interest and momentum in the Magnificent Seven and in big tech as the reality is finally set in. And you and I talked about this in our last episode on stagflation. The reality is setting in that we're back to a real world in a macro sense, where inflation is staying elevated, interest rates are going to stay elevated, and guess what? You need to make decisions again as businesses, consumers, and investors. All right, that is the catalyst now that is going to settle out this current overvaluation away from the Magnificent Seven and into real value. And because it's not just commodities and whatnot that have been kept down, it's all across the board.
So the dot-com era did not end because, I don't know if you guys remember this, but that when New Year's happened in 2000, that everything was going to be obsolete, right? Oh no, we have to do this with our computer. Anyway, so there's not some big conspiracy theory out there. There's not, there's not a handful of the powerful, right, that are making the trend happen. What comes to mind for me is the because the art of investing has changed so drastically since when I started out in this industry. Now you've got money managers and et cetera, but because small stocks are good, right? Everybody wants to get into the next what started in somebody's garage that's going to make them billions and billions of dollars. Those are still out there. There's still value to be had out there.
For sure.
So with 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 natural resources and commodities going up and all of these different things in play and the herd mentality, and companies are going, what in the world is happening here? What factors are you seeing that are starting to come together to see a little bit of that transition back into the value and people looking under the hood and not just, running around throwing beads and celebrating, following the trendy stuff, the flashy stuff that's going on?
Right. Well, look, we've already seen in the last couple of years. I'm going to give you a couple examples, folks. But first, I want to second something you just said, Connie. I'm going to share a couple of my crack cartoonist, Jerry King. He's done cartoons for me for a very, very, very long time. And here's a couple oldies but goodies. It did used to be once upon a time, because a lot of the culture has changed, that has accentuated this trend of, oftentimes with computers, chasing momentum, chasing the hot stuff, and ignoring everything else. Once upon a time, people, when it came to stocks, did use some greater deliberation. You kicked the tires, you looked at balance sheets, financial statements, the industry, and whatnot. And these days, like the second cartoon shows, it's become almost a computer game for a lot of people. For a lot of people, it literally is a computer game to trade stocks, to follow whatever's hot. Doesn't matter what's going on in the real world around you. So there's been a lot of that culture change. But there are times, again, and I use the example of 1929, when 1 out of 3 stocks went up as the broad market average dropped by nearly 90%. We're going to start seeing more of that again. And we've already seen the first taste of this. When the Fed finally realized it had made an enormous mistake by printing so much money in 2020 and 2021, and they started to raise interest rates, the broad market did react in 2022. People forget that now. The S&P 500 and NASDAQ had a short but sharp bear market. They're down 20 to 30%, depending on which of these indices you want to look at. Yet, if you were invested in energy in 2022, you made some good money. If you were early on in big moves back then in uranium, especially lithium and some other battery metals, you were making money. Because for a while, you started to see back then that investors, and I'm talking about across the board, individuals and institutions alike, said, maybe things aren't as easy anymore. You can't just close your eyes and buy the new FANGs or the Magnificent Seven or big cap tech or whatever. Because interest rates are going up, the market's going to take a dump. Now we got to look out for what's real. So it started to work for a while the way it should. Last year, that got reversed again, because surprisingly to a lot of people, despite the Fed continuing to raise rates and then holding them at their present level, the overall market started to rally more. Why? Because, and we talked about this in a great stagflation video, because there's still lots of liquidity out there. And then that fed the momentum. People started chasing momentum again. So we went right back to what we were doing collectively. But now here in 2024, after last year's big move back into the Mag 7, nobody caring about commodity stocks, nobody caring about small caps. I mean, even biotech stocks. And get this, folks, those of you out there that think that maybe this is just about commodities getting short shrift. There was a stretch where something like a third of all of the biotech stocks out there, because they were so far underwater, everybody chasing the Mag 7, they were selling in the market for less than what the cash was that they had in the bank. I mean, this is getting really stupid, and even beyond the commodity stocks. So that continued, as we all know, now into the first quarter of this year. But now reality check is coming back to the markets, not just from us. But Jerome Powell finally, just since you and I did that stagflation video, Connie, he finally had to come out and admit what we already knew. And guess what, folks? We're not going to lower interest rates anytime soon, because inflation isn't coming down, because the economy, thanks to all of the obscene levels of liquidity we put in before, is still doing at least halfway decent. So that's going to start to bite more and more on the economy. It's going to start to bite more and more on the markets. Okay. And it's going to reaccelerate the trend that started in 2022, got interrupted since then. All right. I want to give a specific example here for just a second on precious metals. All right. And show you what it's going to take for investors to wake up and to discover the numerous great values that are out there. At the bottom of the market after the 2008 crash, gold bottomed at $670 an ounce. It took less than 3 years for the gold price to triple from that point. Back then, unlike what has happened with the recent move in the gold price that's had relatively little impact yet on the gold stocks and silver stocks, back then, the gold stocks did go parabolic. In fact, to this day, you go back to 2011, and precious metal stocks as a group are still selling, even after some rallies recently, for 30, 40% of what the peak was back then with a higher gold price. All right. But what happened back then, and still has yet to happen in a big way now, and this is the punchline. Back then, the economy was toast. You'd had the crash thanks to the over activity in mortgages and housing and that whole bust. The Fed was lowering interest rates to nothing, printing money. It wasn't having any traction anyplace else. And what happened that caused, for the first time in a while, a disproportionate amount of investors' attention to go to precious metals is that all this other stuff stopped working. Okay. And that's what we're only seeing initial glimmers of now. The Mag 7 stories only work in an environment of subdued interest rates and free money and stuff like that. Less and less are they going to work going forward. I mean, you look at companies like Apple and Amazon, especially, they're glorified utilities now when you look at them, and yet everybody is still all piled into these things. So we're going to see that come around again. It's been halting on and off, as I've said recently, but that will come again.
Okay, so that is good news that,
Yeah.
you know, we're coming back to the value portion of the equation. So are there a couple of resource stocks out there that you see this happening already? Are there people leaning in because of a variety of different factors that the companies are doing to get their value across to the money managers and the individual investors and the institutional people?
Well, again, it's going to take a little bit of doing to break this overall herd mentality mindset, because the path of least resistance for individuals, institutions alike, is to go into the Mag 7, the big cap tech stocks, you know, the passive ETFs that reflect them, whatever. As that starts to fail, and we're going to see corporate earnings in a broader sense start to come down because of cost pressures and higher interest rates and so forth, it's going to cause people to become wise shoppers again, individuals and institutions alike. All right. Let me give a few examples, because there are some examples I want to highlight. You know, one of the companies I've followed for a long time, a lithium company, we got in day one, pretty much years back, sold a lot of it at the peak. Right now, that stock is selling for about 80% off compared to what its peak was. That's 70% off compared to its peak. Yet they just inked a deal that was wow to me with Mitsubishi. First deal of its kind that Mitsubishi has done with the raw material provider of future batteries. Okay. The deal with Mitsubishi valued that company's stock at double what it's selling for in the market. Mitsubishi didn't care what the market thinks about the stock right now, because they know what the future is. So they're early beyond investors. A helium centric company that is on my recommended list just a few days ago came out with news of a collaboration with a governmental entity, a First Nations entity specifically in Canada, to co-fund just one of their projects. On that one project, that deal valued the company greater than what the value of the whole company is right now in the marketplace. So a greater value affixed than just that one deal. One of our client companies I'll talk about specifically, Guanajuato Silver, their stock came out. I mean, I knew about it when it literally was hatched, for lack of a better term. And James Anderson, the CEO, is telling me about it. I dragged my feet a little bit, watched the stock start to move up. This is real. This is a great company that's been built from several different assets. It's a great silver and gold producer. You know, the first quarter of 2024, they likely, I don't know when the news is going to come out, but it looks as though they're going to produce more silver and gold than they have ever. And there's been some move in the stock price, but still not nearly what there should have been, especially when you look at the rallies in silver and gold prices too. Another company that I followed for a long time, big company in the exploration space, Seabridge Gold. They've got several assets. Their main asset is in British Columbia in the Golden Triangle. They have got more proven and probable reserves of copper and gold than anybody on the planet, pretty much, that is at their stage. When gold in 2007 it hit 1,000, and then in 2011 that big move up to almost 2,000 before it peaked, Seabridge Gold stock was 40 some dollars a share. It got all the way down to 10 recently. Even now with the rallies in gold and copper, it's still less than half of what its peak was when it wasn't nearly the company, without nearly the progress. They're just about fully permitted now, looking for a JV partner. So there's this disconnect still continues. And again, I could rattle off all kinds of small cap companies in other areas as well. But as I use with the example of the lithium and helium stories, and I'm seeing this repeated elsewhere, folks, and if you're an individual investor here, pay very close attention. The money that can see down the road and knows what's going on, they're very happy right now to be paying way more for a piece of an asset than what the market is reflecting right now, because they know the market is very wrong, and that we're getting to that point, as we've seen when we've had rollovers of this kind of behavior in the past, where the stuff that is at nosebleed valuations doesn't belong there, starts to lose its air, and people start to gravitate to what's real. Last but not least, and look, what we're talking about today, folks, applies to all kinds of small cap stocks, not just resources, but I'm bullish beyond belief on the long-term case for the commodities bullish cycle in pretty much all its manifestations, because it's a story of every single commodity we need as a planet is in structurally short supply. I mentioned Guanajuato silver. Silver is going to have its biggest deficit in 2024 as far as supply, its biggest deficit in 20 years between supply and demand. And here again, people, even though Guanajuato has perked up a little bit, a couple other companies we cover have rallied somewhat, they're still nowhere near what they should be, and I think will be, once we get back to that more sober environment in the market.
So as the sober environment begins to peak around the corner, and investors are looking under the hood a little bit more and asking their money managers some, bigger questions, finding the stories, I mean, I can pretty much guarantee you that 85% of the investors out there are going, well, I didn't know about the Mitsubishi. I didn't know about, they didn't know about it. So is there a way for companies to say, this is our story, to start to bring the perspective and the perception of that value that's starting to come back in for their frontal lobes? Is it simply a matter of somebody just sending out a press release or telling a story, or is there a little bit more meat to it that the companies can do to get the investors to lean in, because their stories, they're not known?
Well, look, the companies need to understand what you and I have been talking about for the last 18, 20 minutes, whatever it's been now, that this is not unique to resources. It's not unique to them. They don't need to have a complex about it. Okay. That these things happen in cycles and markets over periods of time. All right. But to answer your question going forward, they need to figure out what they need to do to get themselves up to the front of the line, so that when the herd mentality breaks and does change and does start coming around to them, that they're at the top of investors' lists. Okay. There's a right way and a wrong way to do that. We've talked about that incessantly on our SMPR web or YouTube channel, rather. We've got a couple of past examples that we've done of videos talking about how the whole landscape of investing has changed and how to make yourself relevant to individuals and institutions alike. But figure out how to explain to people in fundamental, sensible terms why they need to be taking you seriously, why you are an important part to the piece of the puzzle going forward. If you're a gold company, don't be telling people that they need to look at you, because if they don't, next week when Joe Biden introduces his Biden bucks new currency, you're going to be in trouble. Anybody that tells you anything about that, don't walk away, run. Okay, all these cockamamie things that are out there. But there's sound, fundamental, societal, cultural, economic reasons that you can make yourself relevant to people, but it's got to be done in a way that when they start to understand that they need to come around, then the individual investors will take notice. Way beyond even, precious metals or the battery metals and whatnot. I want to share a chart here too that I used the other day with one of the companies I recommended, a national investor. They're an energy company. And we were talking about cycles of specifically energy related stocks. You have multi-year cycles where things do well and you can make a lot of money in energy, and then it backs off for a while when investors focus or fundamentals shift or whatever. Okay. But look at this, folks. Every single time that you had a bullish move in energy stocks, there was a point where all of a sudden you had this sudden acceleration higher. And it was like somebody turned the afterburners on. And back to my point of the herd mentality and things like that, it wasn't because the oil price itself accelerated like that. It was already moving. Okay. It was because the critical mass had been reached in market psychology, where people finally were getting more disabused of what had been hot prior and realizing, holy cow, we need to invest in energy. Let me give you a statistic. And again, 2022 is a great year for energy stocks. This year has been a great year for energy stocks again. Last year really wasn't all that bad, frankly. But 2023, at the end of the year, energy is a part of the S&P 500, accounted for under 5% of the market cap. Yet energy in the S&P 500 accounted for a little over 12% of the net earnings. And even after that, if you look at the charts of the major ETFs and you look at a lot of the smaller cap stocks, the smaller cap stocks still, most of them have not participated in that. Uranium, we've talked about before. Uranium has had a huge move from its bottom. The uranium price is up almost fivefold from its bottom. The bigger cap uranium stocks have all done very well for those who are smart enough to get in on them, but a lot of the smaller exploration companies are still dead in the water. So even that story, you've not yet had so much critical mass. And where we're going with this in the end, and I think it's going to benefit commodities broadly, almost no matter what it is. And I think small cap stocks too that have got good, unique stories, sound fundamentals and stuff will benefit as well. I've always loved to say, and I need to share another one of Jerry King's cartoons here he did for me. I've always liked to say, where it comes to gold and precious metals, and this was evidenced in a big way in that big move from the bottom of the market in 2008 until 2011, when precious metal stocks peaked. When generalist investors all of a sudden realized that they should be taking place with precious metals, it was like, I have always said, a 300-pound man jumped into a kitty-sized wading pool, because the segment of the market that represents these stocks is not that big compared to everything else. When the light bulb really goes off over people's heads in a few years to come, I think it's going to be like an elephant jumping into a kitty-sized wading pool. And we haven't really seen that yet. We've seen good returns for people who got in some of these things early, but the big transition is still to come. And I think with the reality that's setting in now of these enormous federal debts, of inflation, interest rates staying high, this is going to accelerate it. We've started to see glimmers of the commodities themselves moving more. Copper is up big this year. Energy has stayed strong, etc. but the big stuff is still to come. And so if you're an investor watching this, realize that it's very early still to position yourselves properly in a lot of these stories. If you're a company, understand that if you make yourself relevant in the fundamental ways that we're talking about to investors, and we got a lot more for you to come, then you're going to be at the front of the line when people realize that they need to start rolling up their sleeves and figuring out, okay, the Nvidia is too overpriced, or the whatever is too overpriced. What's going to be tomorrow's story, and where do I get in?
Absolutely. Absolutely. And if I recall correctly, the goal for everyone is, wait for it, buy low, sell high. So
Yeah,
as this starts to unfold and this transition back into value versus the trend starts to unfold, not taking policy into account for any of this, which you have to take into account, but get out ahead of it. Get out ahead of it, make a difference, make yourself relevant, do your homework. You don't have to do big homework. Shoot me a note. I can answer a question or get you in touch with Chris and have a conversation, but get out ahead of it. Let's get out ahead of it and make what's relevant to you relevant to everybody, because that's what's going to put you on the map, whether you're an investor, wanting to be the smartest person in the room, or whether you're a company that's got a great story and nobody's leaning in. Let's make it happen. Chris,
absolutely.
Chris, thank you so much for your time. I appreciate it. And, get some knowledge, not just information.
Yeah. You know where to find us, folks. We'll look forward to hearing from you.
We hope you got a lot out of today's subject. Make sure you avail yourself of the resources and contacts offered today. Subscribe to this channel for future topics and opportunities. And if you have any questions, drop us a line. Thanks for tuning in.